Welcome to FXTech's comprehensive USD/CHF analysis for the week of November 17th to 22nd, 2025. In this presentation, we'll examine the critical developments that drove the Swiss franc-dollar pair during this pivotal period. We'll analyze three major fundamental catalysts, review technical consensus from 5 leading sources, and provide actionable trading strategies with clear risk management guidelines. This analysis is prepared on November 24th, 2025, and incorporates real-time data from TradingView, Investing Live, Action Forex, Forex.com, and Daily Forex. Let's dive into the market dynamics that shaped this week's price action. The USD CHF pair demonstrated a significant bullish reversal during the week of November 17th to 22nd, rebounding strongly from the critical 0.7900 support level. The pair closed the week at approximately 0.8085, marking an impressive weekly gain of plus 1.99%. This recovery was driven by a powerful combination of fundamental catalysts and technical factors. Looking at the key performance metrics, we see a monthly change of plus 1.57%, though the year-to-date performance remains negative at minus 8.81%. The pair is currently trading within a well-defined consolidation range established since July 2025, with support at 0.7870 to 0.7900 and resistance at 0.8120 to 0.8150. This recent rebound from the lower boundary suggests a potential bottoming pattern is forming. On November 14th, 2025, the United States, Switzerland, and Liechtenstein reached a historic trade agreement that fundamentally altered the outlook for USD/CHF. This deal represents the most significant bilateral development affecting the pair during our analysis period. Under the key terms of the agreement, U.S. tariffs on Swiss goods will be reduced from 39% to just 15%, with the tariff reduction set to take effect from early December 2025. The agreement also includes provisions for Swiss investment into the United States and removes barriers to U.S. exports to Switzerland and Liechtenstein. The impact on USD/CHF was immediate and profound. The trade deal released upward pressure on the Swiss franc, as concerns about Swiss export competitiveness diminished significantly. This reduced the likelihood of aggressive SNB intervention and provided fundamental support for the USD/CHF rebound from the 0.7900 level. The Swiss National Bank adopted an increasingly vocal stance against franc strength during the week, with President Martin Schlegel making key statements on November 21st that significantly impacted market sentiment. The SNB's current policy rate stands at 0%, maintained since September 2025. Importantly, Schlegel stated that the SNB is willing to reintroduce negative interest rates if necessary, though he emphasized that the bar for such action is high, but not insurmountable. The SNB expressed clear displeasure with the strengthening franc, and verbal intervention suggested that the 0.7900 level is being actively defended. The market interpreted these statements as a clear signal that the central bank is prepared to act to prevent excessive franc appreciation. The consistent defense of the 0.7900 level over the past 6 months, combined with these verbal interventions, has created a perception that this level represents a hard floor for USD/CHF. The Federal Reserve policy outlook underwent a notable hawkish shift during the analysis period, providing fundamental support for USD strength across the board, including against the Swiss franc. The probability of a December Fed rate cut dropped significantly to between 25 and 42% from higher levels earlier in the month. Market pricing now reflects decreasing expectations for near-term easing, with the delayed September non-farm payrolls report scheduled and forecast at plus 50,000 jobs. Multiple FOMC speakers were scheduled throughout the week, reinforcing the hawkish messaging. The divergence between Fed policy, holding rates higher for longer, and SNB policy, maintaining 0% rates with potential for negative rates, creates a positive carry trade opportunity for USD/CHF. Traders are effectively paid to hold long USD/CHF positions, which provides structural support for the pair and encourages accumulation at lower levels. Analysis from all 5 major data sources converges on a remarkably similar technical outlook. USD/CHF is forming a bottoming pattern at the 0.7900 level, with potential for a breakout above 0.8150. TradingView shows a neutral overall rating, but a buy signal on the daily time frame, with a trading range of 0.7870 to 0.8120. Investing Live notes that price is testing the 100-hour moving average at 0.7960, with a break above 0.7980 opening the door to a 0.8073 target. Action Forex observes that the strong rally has dampened the original bearish view, with upside bias for 0.8123 and then a 0.8218 projection target. Forex.com identifies a clean bullish reversal from support, with a break above the 50-day moving average confirming upside momentum and targets of 0.8071 to 0.8150. Daily Forex sees a classic accumulation pattern forming, describing 0.7900 as a hard bottom, with a breakout above 0.8150 required for confirmation. The consensus is clear. All sources identify 0.7900 as critical support and 0.8150 as the key resistance. The USD/CHF pair is currently bounded by well-defined support and resistance zones that have been tested multiple times, creating clear battlegrounds for bulls and bears. On the resistance side, we have 0.8071 as immediate resistance representing the recent high. The 0.8123 to 0.8124 zone marks the October swing high and represents major resistance. The critical 0.8150 level is the top of the consolidation range and the key breakout level. Above that, 0.8218 represents the 138.2% Fibonacci projection target, with 0.8332, the 2023 low, now acting as major resistance. On the support side, 0.8034 to 0.8037 provides minor support as former resistance. The psychological 0.8000 level coincides with the 50-day moving average. Below that, 0.7925 to 0.7930 forms a minor support zone, while 0.7900 is the major support and SNB defense level. The trading implication is clear. The 0.7900 to 0.8150 range defines the current battlefield, and a break in either direction will likely trigger significant momentum. Based on the convergence of fundamental catalysts and technical signals, the short-term outlook for USD/CHF carries a bullish bias with an estimated 60% probability of further gains. The bullish scenario expects a test and break above 0.8071 to 0.8100, with a primary target at the 0.8123 to 0.8150 range top. If the breakout is confirmed, a secondary target of 0.8218 comes into play. Key drivers include trade deal support, SNB verbal intervention, positive carry, and technical momentum. The neutral or consolidation scenario, with a 30% probability, expects range-bound trading between 0.7900 and 0.8100, driven by profit-taking at resistance and awaiting data confirmation. The bearish scenario carries only a 10% probability, expecting a break below 0.7900 to test 0.7882 to 0.7828. This low probability reflects the current fundamental backdrop, which strongly favors the bulls. The midterm outlook for USD/CHF presents 3 distinct scenarios, with the outcome dependent on whether the pair can achieve a sustained breakout above the 0.8150 resistance level. Scenario 1, the bullish breakout, carries a 50% probability. This requires a sustained break above 0.8150, with the Fed maintaining a hawkish stance and the SNB remaining dovish. The target range is 0.8218 to 0.8332, with a recommended strategy to buy the breakout above 0.8150 with stops below 0.8100, offering favorable risk-reward ratios of 1 to 2 or 1 to 3. Scenario 2, continued range trading, has a 35% probability if the 0.8150 resistance holds amid mixed economic data and balanced central bank policies. The recommended strategy is to buy support and sell resistance with tight stops. Scenario 3, the bearish breakdown, carries only a 15% probability, requiring a break below 0.7900 amid a risk-off event or dovish Fed shift. Lower probability given SNB defense and trade deal support. Based on our comprehensive analysis, traders should adopt a disciplined approach that balances the bullish bias with appropriate risk management. For trend traders with a bullish bias, the recommended entry is to buy on pullbacks to 0.8000 to 0.8037 support, or alternatively, buy a breakout above 0.8150. Stop loss should be placed below 0.7900, the major support level. Targets are 0.8123 first, 0.8218 second, and 0.8332 extended, with risk-reward ratios of 1 to 2 or 1 to 3. For range traders with a neutral bias, buy in the 0.7900 to 0.7930 zone, and sell in the 0.8100 to 0.8150 zone, with stops below 0.7880 for longs and above 0.8170 for shorts. Critical risk management principles include maximum 2% position sizing per trade, honoring all stop losses without exception, taking partial profits at the first target, trailing stops on remaining positions, and monitoring news flow closely. Key events to monitor include U.S. economic data releases, Fed speaker commentary, SNB policy statements, trade deal implementation progress, and global risk sentiment shifts.